So good morning, everybody. My name is Alan Sobel, and I'm going to be presenting the business changes in the Tax and Jobs Act, Tax Cuts and Jobs Act of 2017. Just a couple of notes before we get started, some caveats, if you will. First of all, we will be taking questions throughout. You can type the questions in, and we will take them probably towards the end, because there's a whole lot of material to cover in the hour that we have. And if I sort of head off into different directions, it might bog us down and not cover all the material that we want to cover. Secondly, there's a whole lot of material that's included in the slides that I'm just going to be going very fast through. Some of it is just there for your future reference, and then we can certainly provide follow-up after the call as appropriate and necessary with individuals. A couple other things. Number one, I want to be very clear here that I did not write this tax bill. I have no responsibility for what's included in it. My job here today is just to disseminate to all of you as business owners and people that work within businesses some of the more important elements that are different in this act than you might be accustomed to. So again, I didn't write it. I won't evaluate it from a political or a budgetary perspective. I'm going to leave that up to the political prognosticators of the world, and my job again is just to highlight the key broad issues and offer a perspective of how you might be able to take advantage of the planning elements of it. Keep in mind that this bill is only 5 days old. It was signed by the president on Friday morning, and we did have Christmas in between. So to say that we don't have a full grasp of the act is probably an understatement, but we have been keeping track of it since it passed the House, since it passed the Senate, the conference committee, and then ultimately to its signature. So I think we're pretty prepared, but again, there's a lot of nuances, some regulations that are going to come out, and other things that will impact its implementation. This is one of two webinars that we're doing today. The first is on the business changes. The second one will be on the individual changes, and that will be facilitated or discussed by Kenneth Bagner. We are recording this presentation, so if anybody wants to go back and listen to it later, or you have a colleague who's not been able to participate on this call, we certainly will encourage them to go to our website and download or listen to the link of this recording. Last but not least, before we get started, is I do want to thank a few people, Mariana Mogadam, Colleen Logan, Ken Bagner, and others that were so instrumental in pulling this webinar together in a really short period of time. It's clear that most people, unless you've been hiding under a rock, know an awful lot about this bill, and in many cases you've known about it more than we have. We have been receiving phone calls before we've even had the opportunity to necessarily understand or highlight some of the key proponents of it. And so this is in the age of immediate information. We're living in a period of time, real-time information, I should say. We're living in a period where our clients are calling us information that
okay, I'm sorry.
I
realize that, and I need.
That's better. Thank you. Sorry for that. But we're getting real-time information from clients and having to react to it. It makes it very, very challenging. But much of that information is accurate. Some of it is misportrayed. Most of it is not really focused on the breadth of this bill, and that's what we're going to try to accomplish today. So let me dive in. As you probably have been hearing on the news and reading in articles, this is the most significant tax legislation since 1986. I was 3 years young into my career when that act came out, and I remember the hysteria at the time of things like passive activity losses and the limitations of real estate and the like. And, people were in a frenzy, but it seems like here we are 30 some odd years later, and people seem to have settled into the act pretty well, and I suspect that the same will ultimately occur here. It is 503 pages of legislation. I'll be honest with you, I haven't read every page, but I have done a pretty good job of trying to read a great deal of it, particularly the Joint Taxation Conference Committee reports and the analysis of the current law versus what was enacted. The major things that you will find in this legislation that some of you have heard about and some you might not have is that the C corporation tax rate reductions have been significant. We'll talk a little bit about that. There have been reduction in individual rates, and we'll talk about that. You might ask, well, why is that relevant if we're talking about businesses? Because most of our clients and most businesses in America are formed as flow-through entities, and so they get taxed at individual rates, so the reduction in those rates are important. Similarly, the flow-through entity deduction is an area that is a major change. The limitation on deductions of state and local taxes sought by individuals is an important change within the law. The immediate writing off of qualified capital expenditures is also is a key component of this act. Many of you are aware that we have some bonus depreciation today, and we have some immediate writing off under Section 179. This takes that whole provision to a whole nother level. There are limits on the amount that businesses will be able to deduct on interest expense, and that is a major change that we need to discuss. And then the repeal of the 1031 exchange for non-real property also may have some implications for some people that are involved in trading in property as they move up into other higher or newer properties along the way. And then the biggest question that we keep on facing as a result of this act is, should we change to a C corporation? And I'll try to address that as we move along into the presentation as well. So let's talk about the corporate side of things. Again, the most heralded thing that you have seen in the press has been the corporate tax rate has been reduced to a flat 21%. So where we were was there was a graduated rate, but it went up very quickly once you got over a few $100,000 to about 34%, and then ultimately to a 35% flat rate for those companies that had taxable income of greater than $10 million. So a reduction to a flat 21% is very, very, very significant. It is probably the most significant change on the business side of things and how corporations will deal with that. There is also the temporary 100% first year depreciation or write-off of qualifying business property. I mentioned the expense increase in the 179 deduction. In the past, research and experimentation expenditures have been able to be written off immediately in the first year, or you could elect to amortize it over a longer period of time. Now it will be written off over a 5-year period. I mentioned the limitation on the deduction of interest and the elimination of the domestic production activities deduction, which I'll touch on in a little bit. So again, I kind of covered this, so I'm going to go very quickly here. Basically, under the current law, the pre-act law, that your first $1 million was taxed at a blended rate coming in something south of 34%, and then over $10 million it was with 10%. At a flat 21% rate currently under the new law is where it's going. And if you have $100,000 in taxable income, that'll save you about $1,250, not all that significant. But you can see at $1 million, it saves you $118,000 in savings. And for every dollar above 1 million, it will save you 35 cents on the dollar. So again, these savings are significant and beg the question, should I be a C corporation as opposed to a flow-through entity? And again, I'll touch on that in a little bit. Moving along again with C corporations, in the past, there was an 80% dividend deduction if you received it from another C corporation and you owned at least 20% of the stock. You didn't have to include in your income 80% of the dividends. And now that has been basically reduced, and it's now 50%, 65%, and then 70%, and ultimately to 50% after December 31st, 2017. There has been a complete repeal of the corporate alternative minimum tax. I say corporate because I don't want that to be confused with the individual alternative minimum tax. This afternoon, Ken Bagner will be discussing the personal changes under the tax law, and you'll see that that was not repealed, although it has been significantly modified. But beginning years after December 31st of 2017, there no longer is a corporate alternative minimum tax. And again, I want to emphasize that most of the clients that we work with are not C corporations. And so this, for probably most of the people on this call, this will not have a tremendous amount of implication. Okay, But let's now talk about pass-through entities, because that really is what most small to mid-sized businesses are formed as, whether that is a S corporation, an LLC, a partnership, a sole proprietorship. These are the entities that are formed to operate your business, but for tax purposes, they are treated as flow-through, meaning that the income flows through onto your personal tax returns. So basically, in the past, as I said, those are not subject to an entity-level tax. They are taxed through as the individual, and they will continue to be so under the new Tax Act. There's no change in that regard. However, there is a provision that allows you to receive a new deduction for your pass-through income. Whereas in the past, you would have been taxed on 100% of the taxable income of the entity. Now you'll be entitled to receive a 20% deduction of the qualified business income. For simplicity purposes, and you can read the slide, but for simplicity purposes, that essentially is going to be the net taxable income of the business. So if you have $1 million of taxable income, you will receive a deduction on your personal return equal to $200,000. It is akin to an itemized deduction. It appears that that's where it's going to be presented. It's not a reduction of the gross income or the gross taxable income. It's actually a deduction on your tax return. I'm not exactly clear why why Congress just chose to do it that way versus lowering the rates, other than there must be something to do with the way that the income or the loss of income gets calculated along the way. There is a limitation on how you can, that 20%. The concern is that Congress had is that people will abuse that. So let's assume, just for sake of argument, that you are an employee of a company and you negotiate with your employer to treat you as a 1099 independent contractor. If you were to abuse these rules, you would find a situation where you are basically converting wages into business income, be entitled to the 20% deduction, and wind up effectively lowering your tax rate. And so they have put these anti-abuse provisions into the code, one of which is that the limitation, the deduction cannot be greater than 50% of your taxable of your W-2 wages. That is the W-2 wages of the entity itself. You may have heard a little bit about this in the waning days of the signing of the act. Some people, felt that it was what got Bob Corker on board to sign on to this plan. I'm not sure that's the case, but it really was in place to provide real estate entities that does not have a whole lot of wages, a way to deduct, to take advantage of that 20% deduction. And so instead of the limitation just being on the 50% of W-2 wages, which may not exist for some entities, particularly real estate, it also allows you to have a limit. The limitation would apply to 2.5% of the unadjusted basis of qualified property. And what that means is if you bought a building initially for $1 million, even though you've depreciated, let's say, half of it, you still would be able to utilize as part of the limitation 2.5% of the original cost of that property. So it is a way, again, for flow-through entities to take advantage of the 20% deduction, most notably those that are not wage dependent, thinking of real estate as being probably the one that comes to mind for most people. And we are flying through here, so I just want to be clear that this is a very high-level presentation. So the other thing that should be clear is this does not apply to every flow-through entity. It specifically does not apply to service businesses or a trade or business that involves the performance of investment-type activities. Now, they did specifically exclude two service businesses from this limitation, and that is engineering and architecture. So for those of you on the call or those of you who are friendly with architects and engineers, you got a specific carve out to allow you to take the 20% deduction on your flow-through entity that lawyers and accountants and investment advisors and actors, among others, will not be entitled to. Why they got excluded, I'm not exactly sure, but nonetheless, they will see the benefit from this 20% deduction. For those of you or us that are in a service business, you will be entitled to 20% deduction so long as your taxable income is $315,000 and less. If you're an individual, it's $157,500. It does phase out up at that point. So again, there might be a benefit for some people who are in the law or the accounting or other service type businesses to be able to take advantage of the 20%, but it is limited once you reach $315,000 in taxable income. So there are some provisions in the rules that provide that if you change from an S corporation to a C corporation, that may trigger some changes in accounting methods. And what this slide indicates is that those will be treated as what's called Section 481 adjustments. And basically, you'll be required to bring those changes as a result of the income as a result of those changes ratably into your income over a 6-year period. Probably a little bit more of a more detailed aspect of the bill, but I did want to bring that to your attention in case people are considering changing from an S to a C corporation. Again, this is more or less the stuff that really us accountants and lawyers deal with, which is the repeal of the partnership technical termination. I'm not going to spend much time on that because there are more important things that are there, as well as the substantial built-in loss rules that really are not all that applicable to a broad base of people. So I'm not going to get into that under this element. This is kind of interesting here. In the past, the partner was allowed to deduct your distributed share of partnership losses to the extent of your adjusted basis on your tax return in the year that such loss occurred, but it didn't have any limitations related to any charitable contributions or foreign taxes that were paid on your behalf. And now what the local law is going to say is that it will take into consideration those flow-through items in determining your limitations on losses. So basically, in the past, you would have been able to deduct your charitable contributions as an itemized deduction when it flowed through from your flow-through entity. Now, under the new law, it will take a look at your flow-through entity. If it has a loss and you made charitable contributions, that charitable contribution will be limited under the new act. Okay, so this is probably the biggest question that we get from people, and we've been getting it for a long time, but it wasn't even close. Now it's a close question of whether or not you should be a C corporation or a flow-through entity. So let me start with the C corporation. The benefits of the C corp are that it has a lower entity tax rate. A detriment is that it has double taxation. A benefit is that you can deduct your state and local taxes associated with the income of a C corporation. By contrast, a flow-through entity has no double taxation. It's just taxed at the individual level, but it does have a higher level, first level tax. So in other words, I mentioned before, there's double taxation of C corporations. With a flow-through entity, the individual tax is higher, but there is no double taxation. There is a limit on the SALT deduction. So this is one of my pet peeves, which I think is very unfair about the bill. If I am a corporation and I happen to be situated in New Jersey, and I incur an income tax on $1 million of $90,000 in state taxes, I cannot deduct that as a flow-through entity on my personal tax return because of the limitation of the SALT deduction. Whereas if I was a business entity, a C corporation, I would be able to deduct it. And the reason that I find it to be unfair is that historically businesses can deduct all ordinary and necessary expenses of their business. That's payroll, that's cost of goods, that's advertising, that is utilities, that is rent. It's every expense that you have, including the cost of doing business in a local jurisdiction like New Jersey, where you'd be able to deduct that. Under the current law, as it's written now, I should say under the new law, those deductions will not be allowed, and I just think that that's very punitive, particularly to those businesses that operate in states that have an income tax, and it's going to just further make them less competitive in an environment. It's going to raise the cost of doing business in those states. So let's look at a comparison here between the two of them, just show you why one may or may not make sense to you. So if we have the same company making $1 million, As a C corporation, they'll pay $90,000 in state tax, and they will get a deduction, leaving them with about $910,000 worth of income, and they pay a flat federal tax of 21% or $191,100, such that their total entity tax would be $281,100. Let's compare that before we get down to the dividend. Let's compare that to the same flow-through entity that has $1 million of income, has a state tax of $90,000. Will not get a deduction for that, so we'll now pay a federal tax of $296,000. I should have mentioned that 20% deduction that you get for flow-through entities has the functional equivalent of lowering your effective federal tax rate to 29.6%. So even though you're paying taxes at 37%, assuming you're in that highest marginal tax bracket, and that kicks in, I believe, over $600,000 for individuals and $500,000 for single taxpayers. I'm sorry, correction, $600,000 for a married couple and $500,000 for a single taxpayer. The blended effective rate by the 27% deduction using the highest marginal rate would get you down to 29.6. So the federal tax would be $296. Total tax, federal and state burden would be $386,000. Contrasted against a C corporation that would be at $281,000. However, because of the double taxation element of it, if a C corporation were to distribute all of its earnings out to its shareholders, it would then pay a dividend tax at 20% federal and another 9%, say, New Jersey, and combined would be about another $208,000. So the total tax on a C corporation is about $490,000 versus the total tax on a flow-through entity about $386,000. And so you can see that when you aggregate it all together, it's still cheaper to be a flow-through entity than it is to be a C corporation. Having said that, any entity that's going to continue to retain its earnings forever and ultimately looks to sell its business and is able to structure it as a stock deal versus an asset deal, which may in and of itself may not be the easiest thing to do, then maybe a C corporation would make better sense to you. Facts and circumstances will dictate what is the most appropriate for you, but you can take a look at this as a general rule and see that generally speaking, you still are going to be better off as a flow-through entity with some exceptions that may make sense for a C corporation. You can also see here where service businesses that are not entitled to the 20% deduction. You'll see here that their total tax is about $460,000, and basically it still is advantageous for a service business to be a flow-through entity versus a C corporation, although it gets a little bit closer if you aren't going to distribute. It gets a little bit closer, and if you're not going to distribute the earnings, then it might be better to be a C corporation. But then you'd have a tremendous amount of accumulation of earnings within your company, and that may or may not fly. And then, of course, there are some special rules around professional service corporations that require you to distribute all the money out before the end of the year. So, again, this is illustrative of just an example of what it may look like, and just to answer the question of, am I better as a C or am I better as a flow-through? And at least my initial analysis indicates that you'd be better as a flow-through entity, regardless of the lower corporate tax rates. Okay, so let's dive a little bit into capital expenditures. This is another big part of the act that are affecting businesses. So basically, in the previous act under Code Section 179, you could deduct a maximum of $500,000 for the cost of qualifying property, and when you had qualifying property that you purchased during the year, placed in service in the year, that exceeded $2 million, that $500,000 was reduced. It began to be phased out. It will continue to be phased out under the new rule, but that phase-out threshold is increased to $2.5 million, and the Section 179 deduction actually is increased to $1 million. So it goes from $500,000 to $1 million, and the threshold phase-out goes to $2.5 million from $2 million. It also expands the definition within the code to include certain tangible personal property used predominantly in furnishing lodging or in connection with the furnishing lodging. And it also includes to include the following improvements to non-residential real property, so long as it was placed in service after the the original date that the property was placed in service. So new roofs, heating systems, ventilation systems, air conditioning, fire protection, alarm systems, and security systems. Historically, those would have been considered components of the building itself and therefore not subject to be eligible for Section 179. Under the new act, those will be eligible for 179 and will be deductible by the entity in the year that it's placed in service. So again, that's a more generous thing. This is very big here too. While it won't be permanent, it is the current law provides an additional first-year bonus depreciation of 50% of the adjusted base of qualified property placed in service before January 2018. So long as that property's original use began with the taxpayer. So what that basically means is that if you acquired used property, it was not subject to the, it would not have been eligible for bonus depreciation. And then that 50% bonus depreciation phased out over time. Under the current act, under the new act, I should say, it's going to allow for a 100% first-year deduction for the adjusted basis of qualified property placed in service after September 27, 2017, and before January 1st of 2023. So let's talk about that for a minute. So this is a retroactive provision. So for all of you listening here today or businesses that have acquired acquired property subsequent to September 27, 2017, you will be eligible for this 100% first-year deduction on that property in 2017. So this is good news for those people who have bought an equipment during this period of time. It will remain in effect. The 100% bonus depreciation will remain in effect until January 1 of 2023, after which time it begins to go down. So you'll see in the slide that it goes down to 80% through January 2024, 60% to January 2025, 40% to 2026, and 20% to 2027. This is next point is really critical. This bonus depreciation is allowed for both new and used property. So whereas the old law only applied it to new property, under this new act, you will be able to apply that to used property as well. So that will be good for a number of industries, and I'm going to talk a little bit about the impact on the 1031 exchange later on, and this is good news for those that might be involved in a 1031 like-kind exchange as it relates to the relinquishment of non-real property. Another generous provision of the Act is the increasing of the deductions for luxury automobiles. So for businesses that used automobiles in their business, there was a limitation on the amount of depreciation they could claim in any one year. Essentially, the first year limitation was $3,160. It then went up to $5,100, it went up to $3,050 in the third year and $1,875 for years thereafter. Under the current law, under the new law, the depreciation, the luxury depreciation, is going to be increased for cars placed in service after December 31st, 2017, to $10,000 in the first year, $16,000 in the second year, and then it goes down from there. So this is going to be good for those that are purchasing vehicles. In the past, it often made sense for people to lease vehicles because the write-offs were more generous. This may reverse that trend and make it, from a tax perspective at least, more beneficial to be a purchaser of a vehicle than from a tax perspective, than a lessor of a vehicle. This is one of the more esoteric elements. Basically, it deals with the reduction of depreciation on real property if you elect to use a straight line method. If you continue to use the accelerated methods, the lives haven't changed. So most of our clients, most people we know, tend to utilize the more generous accelerated depreciation methods for real property. So I'm not going to spend much time beyond what I've already said on that. So under the current act, under the current law, I should say, qualified leasehold improvements, which were entitled to a more generous life with regard to depreciation of 15 years, if they were qualified leasehold improvements, you'd be entitled to this 15-year deduction. And it also provided for special depreciation and the ability to deduct bonus depreciation, essentially, on property that was used in a restaurant and property that was used for qualified retail properties. So it provided for some more generous bonus depreciation in those two instances. Now, under the new law, the separate definitions for qualified leasehold improvements related to restaurants or retail improvements are eliminated, and essentially you're entitled to utilize the shortened depreciation measure or bonus depreciation on anything that would be a qualified improvement to the property as defined by the Act. In the old Act, it eliminated, you couldn't do it for things that were like an elevator or added to the enlargement of the building or an internal structure of the building itself. Under the current Act, they've just consolidated all those definitions together. Okay, this is also another, I think, a surprise for a lot of people under the new Act, and that is the limits on the deduction of business interest. So under the current law that was in effect, any interest by a business that's paid or accrued is generally deductible in the computation of taxable income. It is subject to a certain number of limitations, like the tracing rules. If you pull money out of if you borrow money and you use it for example, personal reasons, there will be limitations on what you can deduct. But as a general rule, if you use interest for your trade or business, it is deductible under the current rule. Beginning after December 31st, 2017, regardless of your form of business, and those businesses had gross receipts for the last 3 years of excess of $25 million, that's sales of greater than $25 million, there will be a disallowance of a deduction for net interest expense when it exceeds 30% of your business adjusted taxable income. So let's break that apart for a minute. First of all, this applies to businesses that have income, gross income, revenues essentially, of greater than $25 million. If you do and you have interest deduction, your interest will be disallowed if it exceeds more than 30% of your business adjusted taxable income. Business adjusted taxable income is essentially the net income of your business before interest expense and before depreciation. So if you have a business, hypothetically, that it makes $500,000 net, has $100,000 of depreciation, that would be $600,000. And so you would take 30% of that $600,000, I'm sorry, and had interest of, let's say, $50,000, you would take 30% of $650,000, and if your interest exceeded that amount, you would have a limitation or on that. If you can't use it in any particular year, it does roll forward to subsequent years, and so it's not that you will lose it, it's just you can't use it in computation of that current year's taxable income. Another change under the Act is how net operating losses would be utilized. So historically, a company that would have a net operating loss would be able to carry that loss back for 2 years, and then anything that was left over would be able to be carried forward another 20 years. By carrying back a loss, you were able to recover previously paid taxes, and under the and that would help businesses that were suffering to be able to recover taxes they had. Under the new law, NOLs arising after December 31st, 2017 will no longer be subject to a 2-year carryback, and those carryback provisions are repealed, but you will be able to carry it forward indefinitely. And the other key component is that NOL will be limited to 80% of your taxable income. So if you have $1 million NOL and next year you have $1 million of income, you will only be able to utilize 80% of that NOL, such that you'll be left with about $200,000 of taxable income in that year. Again, that NOL is not lost that you're not able to use. It will continue to be carried up over until it ultimately is used. So the big takeaway here is, number one, you can't carry back, which I think is going to hurt some businesses that look to recover previously paid taxes to help their liquidity and strengthen their balance sheet. And then as it goes forward, you're not going to get the full benefit of it in subsequent years. It will have some limitations on how much will be deductible. Okay, moving along, tax credits and deductions. So under the old law, for those that were involved in manufacturing and other production type activities, there was an ability to deduct 9% of the qualified production activity income from your tax return. That now is repealed under the new act. It's more or less been replaced by the 20% deduction for flow-throughs, and corporations, C corporations, are getting such a low tax rate that it was felt, I believe, that the DPAD was no longer necessary to compete globally, and that's why it was eliminated. I mentioned earlier like-kind exchange treatment. So just by way of background, historically, if you exchanged a property, whether it was real or tangible personal property, for a property of like kind, meaning real estate for real estate or equipment for equipment, you could have deferred the gain on the trade-in from that transaction under what's called the like-kind exchange rules. Section 1031 is what governs those rules. And it was good for a lot of industries. The real estate industry uses it all the time. The aircraft industry, particularly private aircraft, use it all the time as people trade up into more expensive or more modernized or newer type of aircraft. And under the pre-act law that existed, under the new law, it has been modified significantly. As it relates to real estate, nothing has changed. The 1031 exchange will still be available for real estate, but it will be eliminated for non-real estate properties. So tangible personal property is the one that is probably most in line. So again, if you think about an airplane, a private aircraft, if you decide you want to trade up, you are going to not have Section 1031 available to you. And as a result, you will be subject to the recapture tax of all the previously taken depreciation, which could be substantial if you've used bonus depreciation, or you have held the property for probably somewhere in the neighborhood of 3 to 5 years, where you're taking a lot of depreciation on this aircraft that could be written off over between 5 and 7 years. So this is going to hurt, those situations where you have trade-in of equipment. Having said that, there probably isn't as much of a hurt as you might think, because if you recall earlier on, we talked about the immediate expensing of tangible personal property. So take the aircraft, for example. You may have to recapture all that tax and not be subject to the 1031, but if you buy a new aircraft and you use it in your business, you will be entitled to deduct 100% of the purchase price. So that may, if you're paying more, if you're buying an aircraft of greater value than your other aircraft, chances are you're going to wind up not having any recapture tax to begin with, because it would be sheltered with the expensing, the immediate expensing of the property. And so even though the like-kind exchange itself seems on the surface to be a negative implication, because of the immediate expensing of under the depreciation rules that exist, it's my belief that the impact on this is going to be nominal, at least until such time as those immediate expensings begin to phase out. So at least for the next few years, I think you're going to be fine if you decide to do a exchange or trade-in of a piece of property. But as we get closer to 2024, when those bonus depreciation 100% goes away, it's going to require a little bit more thought and a little bit more planning on how you avoid the recapture and the negative tax consequences of trading in fully depreciated or partially depreciated property. I mentioned this before. This has to do with research and development expenses, and how you have to now write those off over a 5-year period as opposed to immediately writing it off. Again, it is it is a negative for business owners in that you don't get an immediate writing off, but coupled with the lower rates and coupled with the 20% deduction, you know, all in all, this probably won't be as painful unless you are heavily involved in research and experimentation. It doesn't affect the credits that many of you are taking, but it does affect how you write off the expenses themselves. So under the current law, this deals with the deduction of fringe benefits, employers' deduction of fringe benefits that they're paying. You know, there are some rules that are in place right now where if an employer provides housing and meals for the convenience of the employer, that they are deductible by the employer and non-includable in the gross income of the employee. Starting after December 31st, 2017, some of these deductions are not going to be allowed any longer. For example, if an employer provides meals on premises for the convenience of their employees, those will no longer be deductible under the current law, under the new law. Parking, you know, some employers provide transportation fringe benefits, for example, for parking or mass transit. Again, these will not be includable in the employee's wages, but the employer will not receive a deduction for them. And then I mentioned meals. I should say that meals will continue to be deductible 50% up until 2025, at which point in time those will have phased out completely. So there's a little bit of time still with which to feed your people with bikes getting some deduction, but you will not be entitled to 100% deduction that you would have been entitled to previously. This deals primarily, almost exclusively, with public companies. And it puts a limitation on how much the public company can deduct for compensation to its covered employees, which typically are the highest 4 paid people within the company, the principal executive officer, and the other high-paid individuals. And basically, it limits it to $1 million. That $1 million was in place under the current law, but anything the corporations were allowed to deduct anything that was performance-based, based upon a bonus, clear defined objectives. Under the new act, basically, it's going to be capped at $1 million. And seeing that I don't have, as a firm, we don't really represent too many large public companies, I don't think there's much more to say on this other than there will be some effect on those corporations. You know, in the past, there was a limitation on how much you could deduct by a business in lobbying for political, for political candidates or legislation, but there was not a limitation for lobbying in front of local government bodies. The new law now puts a limitation on your ability to deduct lobbying expenses if you regard to legislation before local government bodies. Personally, what I'm not clear on here, and I hope this isn't what it's going after, but there are many real estate entities that need to go before hearing panels, zoning boards, and the like, where they are looking to get something approved in a town. And oftentimes there is a change in the zone which requires some form of legislation, and I use that term in quotation marks. I hope that the legal costs in doing that will not be affected by this. I don't think it does, but again, these are kinds of things that might come out later on as they write the regulations on these issues. This is actually a nice feature to promote companies for paying Employer-Paid Family Medical Leave Act. So under the current law, you know, employers can pay for FMLA and they would not receive any benefit. Under the new act, if you agree to pay wages to somebody after December 31st, 2017 on the FMLA, you will receive a credit of 12.5% of the amount of wages you paid to the qualifying employee during any period in which the employee is on a Family and Medical Leave Act leave, so long as the rate of payment is at least 50% of the wages normally paid to an employee. So basically, if you decided to pay an employee 50% of its wages, you would be able to receive a credit equal to 12.5% of those wages, paid to them. So basically, the government's going to help subsidize Family and Medical Leave Act payments. This is one of those things that I think you have to sit down and say, okay, what would it really cost us, and are we willing to do that, from a business perspective to make sure that it happens? But this is a way of a government trying to support companies for doing that and helping people that are on medical leave. Some accounting changes. This is interesting. So basically, if you are a company that has $25 million or less in gross receipts, you might not need to account for inventory any longer, and that would be, really quite helpful to those businesses because first, it's a lot of time and a lot of effort to track inventory. Second of all, think about the inventory you have on your books and what a benefit that would have in terms of being able to write that off immediately as opposed to having to capitalize it and then write it off as you sell it. It's one of those areas that I think, you got to take a closer look at because there are some rules that talk about conforming to your financial accounting treatment. And so there may be some issues centered around bank covenants and just financial reporting that might preclude you from taking full advantage of this. Again, we're here to help in that regard, but it's just one of those things you might want to probably take a closer look at. Under the current rules, if you have a company that has annual gross receipts of $10 million or more, you're subject to what's called the Uniform Capitalization Rules, which essentially has you increase your inventory by certain expenses that would ordinarily not be capitalized, like your purchasing department and things of that nature. And what the new act does is it raises it to $25 million. So if you have $25 million of gross receipts or less, you would not be subject to the UNICAP rules. This is a simplification proposal which we fully support because doing UNICAP rules, Uniform Capitalization rules, is very difficult and time-consuming on many of the companies that we work with. So I'm going to open it up for questions right now. You can type them in. I should indicate to you all that these slides will be available on our website after the call, and we, as I mentioned earlier, we are definitely going to be recording this, and if you're interested or want somebody else to listen in, they're happy to do so. Okay, so far we have one question. So it says, currently, New Jersey still exceeds, I can't read it, hold on. Still exceeds this federal mandate. Okay, so current. So Donald, I'm not sure I understand your question. So perhaps you can retype it. I'm sorry about that. Somebody had asked about entertainment expenses. So yes, good point. It was in the slides, but I went over it I kind of passed through it very quickly. So under the new act, entertainment expenses will no longer be deductible. Meals will still be subject to the 50% limitation up for a period of time, but other entertainment expenses like sports tickets, golf, rounds of golf, a day of beauty at a spa, all those things that may have had a business purpose to it from an entertainment perspective will no longer be deductible under the current act. Question is, do the credits for the Family and Medical Leave Act, do they carry through on pass-through entities for the shareholders of those corporations? It's a great question. It's my understanding that they will. There's nothing that I have read that would indicate that those credits would not flow through to the individuals. Much like research and development credits flow through to individuals or work opportunity tax credits flow through to individuals, it's my sense that these FMLA credits will also flow through to the individuals. Again, somebody had asked any changes related to write-offs for entertainment expenses, i.e. meals. Again, I covered that just to reiterate. Meals will still be allowed to be 50% deductible, but entertainment expenses will no longer be deductible under the Act. So I'm not sure what's going to do for the entertainment industries, but that is a change. Travel is still deductible. The question is travel still deductible? Yes, travel used related to business is still deductible. Commuting has never been deductible, will continue not to be deductible, but travel for business purposes will be still deductible. There has been no change as far as I can tell under the Act. Somebody asked if there is a complete list of allowable entertainment expenses in the Act. In the Act itself, it doesn't provide a complete list of entertainment expenses. My sense is that there's going to be commentary written about this as the days move on. Chances are the IRS is going to provide some guidance in this regard and through regulations. But at the moment, there's, other than the carve out for meals related to entertainment, it just bundles everything together as entertainment expenses. Okay. Let's see. FLMA and New Jersey leave. Okay, so the question was, the Family Medical Leave Act and New Jersey Family Leave run concurrent, and New Jersey Family Leave pays up to 6 weeks on disability. So the optional deduction for FMLA. So the question I think is, and I apologize, it's a little hard to read here, but I think the question is, New Jersey pays 6 weeks worth of a leave, and if you can, and now this credit would come in. So I believe that the credit would apply to only what the company pays, and so if New Jersey, if you're subsidizing New Jersey's payment of a family medical leave, and you're paying at least 50% of the wage under here, I do believe that you'd be able to get the credit anyways. Again, I wish I could be more specific. This is a very new act, and there's a lot of nuances that we're just not really clear on how this will ultimately be applied. But at least as my understanding of it, it's if the company pays, regardless of what the state of New Jersey may do, you still would be entitled to receive the credit on your tax return. Somebody asked, are office holiday parties still deductible? I think that they probably will not be deductible as an entertainment expense. I don't think those would qualify for the meals. The meals that they talk about in the Act are meals when people are away for travel. And then there's a specific meals provided on premise. So I guess if you have your holiday party in your office, maybe it'll be deductible. But if you do it outside of the office, I'm not so sure that it is deductible. Just not really sure. Again, these are things that will hopefully be further defined as they go along. But I think there might be a limitation on the holiday party, although I may be wrong on that. A question is, if an individual owns multiple residential real property, is each property eligible for the 20% deduction? The answer to that question is yes. Actually, the way that the 20% deduction will work is it relates to the individual property. It's not done on the aggregate. So each of the tests with regard to the limitation of the 20% will be done on an entity by entity basis as I read the law. So the answer to your question is yes, every entity will be entitled to the 20% deduction, but it will be done on an individual basis or tested on an individual basis. Okay, so this is a great question. I'm skipping over a few because I think I've already answered a few of them with other questions. But regarding changing from a flow-through to a C-Corp, if I don't plan on selling the business anytime soon and I hold most of the income in the business, isn't the time value of money, having all that extra money continue to invest in growing a business, good enough reason to change to a C-Corporation? And the answer is, it may. A lot of it depends on the time value of money, right? What's the interest rate? What can you earn on that money? And how long you intend to hold it for. I will say that ultimately, if your business is sold, the double layer of tax will will be detrimental. It will cost you a lot of money. but you could run numbers and determine whether or not it makes sense. That might be the one instance where it does make sense, where you accumulate the money inside the C corporation and you have no intention of ever selling or pulling the money out, that it might make sense for you to be a C corporation. But ultimately, there's going to be another level of tax, unless, of course, you can structure a sale transaction as a stock deal, in which case there would only be one level of tax as a capital gain on your sale, and that would be the ideal situation. Having said that, you have the conflict between buyers and sellers of a business. Sellers always want a stock deal and want to treat it as such. Buyers always want an asset deal because they get to write up the asset to its fair market value, and they get to depreciate the purchase price over the lives of those assets, as well as goodwill over a 15-year period. With the bonus depreciation and some of the more generous depreciation rules, it's very possible that they could write off a good chunk of the purchase price all up in the first year. And you can only do that on an asset deal. And so an asset deal is very punitive in a C corporation. So I guess the bottom line answer is it would depend on the facts and circumstances, but that is, you lay out the one circumstance where it very well may be, or one of the circumstances where it very well may be beneficial to convert to a C corporation. But please be careful. Don't do it in haste. Once you convert to a C corporation, it is very, very difficult to go back to an S corporation, and so or an LLC converting to a C corporation. It's very hard to go back to an LLC or a partnership. So you really have to take your time and do it carefully. Don't rush to do something because of this particular change in the Act. So it looks like I've run out of questions. I've covered them all, and it looks like we're running out of time. So let me start by thanking you all for participating here today. I know this was fast and furious, and we covered an awful lot. We will look in the coming weeks ahead to provide perhaps more detailed webinars or written communications on some of the more broader and more difficult aspects of the Act. And I just want to remind you that the slides will be on our website, that we will have a recording of this up as soon as we possibly can. And I welcome you to email me with any questions that you may have. My email is on the front of the Power Deck, but I'll give it to you right now as well. It's my first name, Alan, ALAN, .SOBEL at Sobel Co. LLC. That's SOBELCOLLC.com. Alan.Sobel at SobelCoLLC.com. Wishing you all a very, very happy and a healthy new year and a prosperous new year. And we're here to help you navigate, I should say, through this very complex and interesting tax act. Thanks again for participating, and have a great day.